Welcome to a work session for the Salem City Council and members of the Budget Committee, as well as our Councilor-elect Warren Bednarz, who will be joining us this evening as well. And I'll just turn it over to Linda Norris to introduce our speaker.
Thank you. We're very pleased this year, for the third time, to have the expertise of Tim Dewey, Director of the Oregon Economic Forum from the University of Oregon. His qualifications include a master's and a doctorate in economics from the University of Oregon. As we've talked before, he has work experience in Washington, D.C. with the U.S. Department of Treasury as an economist in an international affairs division. Tim has consulted for clients in the financial industry and was responsible for monitoring the activities of the Federal Reserve and currency markers, sometimes too, I think. In 2002, Tim returned to the University of Oregon. He's the author of several economic indices and has published in the Journal of Economics and Business. Tonight, Tim is going to share his insights into the broader economy as well as that of Oregon and Salem. We use his comments every year and his expertise to help us in our financial forecasting process and to measure as we go through the year if there are any significant changes in the economy. So I'd like to turn it over to Dr. Dewey.
Great, thank you. Could you remind me how much time? I've apparently eaten up some of it. How much time?
30 to 45 minutes if you need that much.
Great.
Okay.
So, give a quick roadmap of what I'm going to talk about tonight. First, a quick U.S. economic update. I think the main points we're going to hit is that this recovery has been slow and steady. The positives, monetary policy, housing recovery. Negatives, the rest of the world, and fiscal policy. We'll talk a little bit more about those. Quick look at Oregon. Quick look at Salem, and then looking at some forecasts for Oregon job growth under a couple of different assumptions, and then looking at some Salem numbers too and seeing how we're faring in that regards and what we might think about the revenue implications of that moving forward. So that's where we're headed with this. And I'm going to start with basically a story I've been telling about the U.S. economy for quite some time, that if you cut through the numbers, if you cut through the ups and downs that you see in the data that the press reports upon, so you get a picture that's pretty straightforward. Slow and steady growth over the last 3 years now. You've had some ups and downs, but if you look at the red line, which is the year-over-year change, that is a remarkably steady trend over this period of time. It's still not enough to lift the economy where we would like to be. So this still speaks to the problem that many municipalities are facing, that even though economic activity is bouncing back, it's not bouncing back enough to lift revenues more generally. This is a picture of real gross domestic product, so national output, versus where we think it should be, potential gross domestic product, the blue line. And we still have a very wide gap. And we would need much more rapid growth to close that gap than we've seen. And most forecasts do not see that kind of rapid growth anytime soon. We'd probably be thinking about 2014 before we see something along those lines start to emerge, if we're lucky. So, also, another point that we see this, U.S. non-farm payrolls. And this is another issue that gets a lot of play in the press, the ups and downs of the payroll report. You cut through the numbers for the last 12 months, on average, we've been growing 160,000 jobs a month in the U.S. There's been some big months, there's been some weak months. The last report actually was again, the same story. If you cut through the numbers, you're still moving along at that slow and steady rate of improvement. That's enough to lower the unemployment rate gradually. It's not enough to make huge gains, but it's all movement in the right direction. Where we're seeing a little bit better news is in the housing sector. This has obviously has been something that has been depressed for a long time now, and some of us were wondering if it was ever going to recover. But we're now starting to see the first glimpses of light. The glimpses at the end of the lights at the end of the tunnel. I know that in comparison to how far we've fallen, those little gains don't look like much, but they are pretty significant in light of the bottom that we were at. And we're seeing this in all sorts of housing, but a big chunk of it is multifamily housing. And where we've seen rents or vacancies drop in a lot of municipalities, that's been triggering for firms or developers to start putting in new multifamily units. It was simply, in many ways, just a matter of time before some of these forces started to come back. If you have growing populations, growing household formation with improving labor markets, you're going to end up with a need for new housing sooner or later. In Oregon, we've seen this happen. Much of it has been prevalent in the Portland area, and we'll talk a little bit more about that as we go forward. We can see Oregon's trending in the same way, where residential permits are starting to rise. Again, I know it looks like not much, but from 500 units a month to 1,000 units a month, that's a doubling of activity. It's in the right direction, and where we expect it will continue to do is rise further, I think, in 2013, 2014. So the upshot of that story is slow and steady with some good news in housing, and we know housing has been a significant factor in holding back the recovery. Now, just as we seem to get that one thing online, then we get hit with other things, one of which is this external picture. Manufacturing activity is clearly under pressure. The blue line here is non-defense capital goods, excluding aircraft. So this is core capital goods for firms use to invest and expand operations. That is clearly negative, and basically is in what you think of as recession territory. What we have, though, is industrial production overall. The red line is continuing to expand. Now, will industrial production go and meet its colleague there? And that's the big question right now. And what it depends upon is how much of that decline in manufacturing activity we're seeing right now is really due to external factors. And I think the general sense is, if you look at the rest of the world, believe it or not, the U.S. is something of a bright spot. And that's something we haven't been able to say for a couple years. This is a picture of U.S. and Europe real gross domestic product, and the Eurozone is the red line here, which was tracking the U.S. in 2010 and the first part of 2011, but is now on a downward path into recession territory. We've seen similar issues with China. China's experiencing a growth slowdown. So what we see from the rest of the world is a drag on exports. Now, if we go back to what happened in the Asian financial crisis, we had a pretty significant drop in trade activity among some of our partners. We did not get a U.S. recession out of that, despite some predictions. What we did get was a slowdown in certain sectors, some of which were manufacturing. Right now, we're starting to see that slowdown emerge, and if we see the same patterns we saw in the Asian financial crisis, I don't think you'll see that spread into a general recession. That would be really those channels are relatively weak. And on top of that, we have the housing recovery going on, and it would be very unusual to have a recession during a housing recovery. Although we can make that happen, and we'll explain how we do that later. Actually, we'll do it right now. And we're going to do that by talking a little bit about what the federal government is doing. And the problem or the challenge there is that we've had a policy of austerity, fiscal austerity in this country dating back to 2010, when fiscal spending really started to become a drag. Actually, what's interesting is that little bump at the end is what really saved the third quarter growth numbers from being below 1.5% to the 2% it turned out to be. It was really that fiscal impetus that was helping sustain growth into the end of this year. And the challenge that we're facing is looking into 2013. We know that Congress and the President have to make some agreement to avert a fiscal crisis in the U.S., and unfortunately, we don't really know how that's going to play out. The baseline scenario is that Congress and the President reach a compromise, which they always do. And that compromise will still be one of fiscal austerity, but it won't be the recessionary cliff that would be the worst case scenario. And that's the real challenge going into the beginning of next year, is where do we end up on that story. And I don't think we've moved far enough past the election to get a little more clarity on that particular issue. We also have another debt ceiling debate coming up. And if you remember that from 2 years ago, that was a disruptive discussion that the country had. So that is hanging out there as something that could potentially derail the expansion. But again, Congress and President have trended to find solutions to these things at the end of the day, and hopefully that will continue to be the case going forward. And that's why that becomes most of the baseline scenario. The Congressional Budget Office estimates that you will end up with a recession in the first half of next year if they cannot reach it, if the full fiscal cliff were to come into effect, despite the housing recovery. You're looking at estimates between $500 and $700 billion of spending, which is actual money, even for the federal government. So that's the external outlook, and the fiscal policy outlook are weighing on us right now. We've had a monetary boost. The Federal Reserve has been very active, has expanded their asset purchase program this last quarter to include basically what we call an open-ended asset purchase program. So they've decided to buy $40 billion of securities a month, mortgage-backed securities, and they're going to do that indefinitely until the economy has improved to the point that they think they can withdraw that stimulus. That is considered a significant boost as we head into next year, and actually it would be an opportune time for the federal government to take advantage of that with additional spending. Unfortunately, we're not going to see that happen. Many people have worried that's going to cause some inflationary outbreak. That hasn't happened yet. We still see inflation tracking along with the Federal Reserve's goal of 2%, or actually probably a little bit below that. So that hasn't been an issue, the inflation, and most economists don't really expect it to be an issue as long as the labor markets are still basically in a weak state with 7.8% unemployment. Wage growth is very low. Without sustained wage growth, it's very difficult to sustain an inflationary impulse, which is why these fears of inflation just have not been realized. So what's going on in Oregon? Well, lots of, generally, I think, positive activity. My measures, the University of Oregon Index of Economic Indicators, for one, has been up for the last, since the middle of last year. It's sort of leveled off in the last couple months, but I'm not terribly concerned about that. Part of it is, I think, some data that's going to be revised, particularly for some of the employment data. We'll talk a little bit about that as we move forward. Part of it's reaction to this flattening manufacturing story that we've been talking about. But underneath it, there's also good stories going on. Again, the housing recovery, initial unemployment claims are down. And actually, I remember that I have a bunch of these charts. If we look at Oregon's measure of economic activity, another measure that I look at, that's been bouncing at 0 or right below 0, and 0 is average growth in Oregon. So I think the story continues to hold, that the recovery in Oregon continues. It might not be the fastest recovery we've ever seen, certainly less than what people I think would expect, but it's still there. So, driving this all back closer to home, which is where we really need to get by the end of the hour, business index components. So I've been calculating these indexes of economic activity, not just for the state, but for local areas and Salem as well. And looking over some of those numbers have shown at least a flattening of activity, definitely hitting the bottom, and then I think in some cases turning up. Willamette Valley residential housing sales, for instance, has been climbing really gradually since the middle of 2010, arguably, but started to get a little bit more activity this year. And that would be consistent with, again, stories we're hearing across the nation of improving housing markets, rising prices. Again, we're climbing out of a deep hole, but the direction is finally starting to move in the right way. Value of residential construction started to stabilize and arguably even start to edge up a little bit since the beginning of 2011. We're not seeing a lot of that housing improvement come through to actual housing construction in this region just yet. It's not terribly different in Eugene. Eugene's had the benefit, for example, of rising university enrollment, so we've had to create apartment complexes, but single-family housing has not been on a tear there either. Where you're seeing a lot more of the construction, again, is the Portland area, where vacancy rates had hit very, very low levels. Solid waste, again, this is considered, again, an odd indicator because you think of garbage as bad, but it tends to be that when the economy is doing well and growing, we produce more garbage, and we produce more garbage that gets sent to the landfill and more that gets sent to recycling. That obviously turned downward pretty quickly during the recession, but has started to, I think, stabilize in the past year. That's also consistent with numbers we're seeing in other parts of the state as well. Lodging revenue was edging upward in the last, at the beginning of this year, and at the end of that last year started to kick up. And this is, again, consistent with what we see in lots of parts of the state, is that travel and tourism activity have picked up in many places a little bit more quickly than anticipated. And so that's generally considered a plus across many parts of the state. Initial jobless claims, again, on the downtrend, still a little bit elevated relative to where we were prior to the recession, but moving in the right direction. Very much mimicking what's going on in the state and national levels as well. And then the state, as I showed earlier, has continued to improve generally over this period of time as well. So if I put those together, and I have to still add in non-farm payrolls for this region, and this has been a tricky series, and we're going to talk a little bit about this later. This is the official data, which would show that there's really not been much of an upturn. I'm going to show you some other data, some unofficial data later, that I think is going to be a little bit more positive, and that's going to be a surprise saved to the end. If I put these together in the Salem Area Business Index, we see again signs of an upturn. We're moving in the right direction. Again, we're coming off of a deep hole, but I think certainly the economy bottomed by 2010, 2011, and we're starting to see a little bit of a recovery happen. Now, I again have another measure that I do monthly, the Index of Economic Activity for the region, and that has tended to be, again, a relatively disappointing figure in that, compared to the last 10 years, I don't think there's any real surprise that the region is growing considerably slower than would be considered average for the region. And that's the story that this measure continues to tell. There was an uptick in the last data in August, and we'll see if that carried through into September and October. And if it did, that would be, I think, again, a story that says we're starting to make a little bit more progress here. And I actually anticipate that to be the story over the next 2 years. So, getting to looking forward instead of looking behind. If we look at forecasts for where we expect the state to go, and we're going to assume or show later that the region is going to follow the state relatively closely, I think. This is Oregon non-farm payrolls, and this is my baseline forecast. And what I've put in there is a 90% confidence interval. And so I'm 90% confident we'll be either in recession or expansion over the next 5 years. Yeah, that's a joke. It's okay to laugh. So that gets you to the sense of some of the uncertainties around these forecasts, and some of the uncertainty is on the upside and some of the uncertainty is on the downside. And how I derived these confidence intervals was to basically run this model 1,000 times, and 900 of those outcomes were in that gray area, and 100 of those outcomes would be on outside of that gray area. And so what I've given here is 10 alternative outcomes, and one is a very poor outcome, unfortunately, but one's a pretty good outcome as well. In the near term, though, those things are pretty much bunched together, and I think we could expect, again, assuming the national economy continues to hold, the national recovery continues to hold, we would expect, again, the Oregon economy to continue to hold as well. Now, I can make some adjustments to this, and one adjustment I do is look at what the state forecast is, and if I put some assumptions in for what the state says GDP growth and U.S. farm job growth are going to be, I get a pretty similar picture. I get a little bit more growth early on, they get a little bit more growth later on, but the story is similar, and it's particularly similar in the near term for job growth. So the state and I are not terribly far off, I think, in the near term over the next year or two. The state's assumptions do give more growth as you move out of 2014 and 2015. And I don't think that's a bad assumption. They're putting in some judgmental assessments into that I think are generally appropriate. So I would actually expect some of my later numbers to head up. We're not going to worry about that. What the general story, though, means for the state is they should have increasing revenues going into this next biennium, and as that I don't see a reason to believe at this juncture that there'd be some big downside surprise, except for the surprises that we know about could happen. I think the state's growth trajectory is relatively secure at that point. You might get some wiggle room on that if some of the job growth that we expect doesn't come about. But the general uptrend should be there going forward. And if there's some wiggle room, in fact, we're probably not going to be able to know about that until 2014, when that would show up in any forecast errors. So I think as we move into this next biennium, unless something bizarre happens, the state will have a little bit of extra money to work with. And of course, there's a lot of people jumping at that money, but that's not an issue right now. And again, we can talk about the same thing. This is Oregon total personal income baseline forecast that turns out to be not very different from the state through a different modeling technique, and then some possible realizations of that. And anything you get that's on the lower part of that is going to be obviously disruptive relative to what the state is thinking about right now. But you're looking at the near term, which is what we're really concerned about right now, 2013, 2014. The band is pretty tight, barring some bizarre event. I think that we're going to be better off over the next couple of years. Now, that bizarre event I've managed to force in, and we call that the Congressional Budget Office Fiscal Cliff. And so knowing some estimates of that, I can force those estimates onto the model, and then I end up with an Oregon non-farm job growth that's more like that dashed and dotted line that falls back into recession in 2013 before rebounding. And that would be, again, the case, the scenario that we're worried about. It's not the baseline scenario, but it's certainly one that would be hanging over our heads as we move into 2013 as a caution. I wish I had more upside scenarios. For some reason, they're all downside scenarios. I'll have to work on the upside scenarios. Economists, I don't think, are naturally inclined for that. So, where does that leave this region? Well, this has been a pretty interesting story. What I've done here is looked at Salem non-farm payrolls, and so that's the black line here. And then I estimated a model of Salem non-farm payrolls relative to state growth through the end of 2007. And then I did a historical simulation. So what I did is I forecasted where Salem should be given where the state actually went. And then forecasted beyond that as to what the baseline forecast that I devised was. And that gives me the blue line. And the blue line would suggest that Salem deviated from its historical norms at the end of 2010, where Salem should have stabilized. The job growth continued to dwindle. And so this causes something of a concern. Is should this have happened? Is this really something that we should be thinking about as an implication for modeling growth into the future? And especially when I kind of look at other parts of the states and say, well, did they break from their trend? And they did a similar story for the Portland area. And what you would say is that maybe they fell a little bit deeper than might have been expected, but then they rebounded back up to trend. So they're not terribly off where we might expect, given national payrolls. I did this one on national payrolls. Now, the issue, though, is that maybe the maybe it's not the Salem economy that's off, maybe it's the data that's off. And this has been a frequent problem for the last year, where the data quality has deteriorated a little bit. And the backstory there is the National Bureau of Labor Statistics took some of the duties away from the local employment economists. And so the people that were on the ground that could adjust the data, judgmentally adjust the data if they saw something odd appear in a monthly survey, are no longer there to do that. And so consequently, we don't get the best numbers until a year later when we get a benchmark series, when we get a revised series based upon unemployment insurance receipts. Now, luckily, we've had somebody in the state Office of Economic Analysis that's been tracking this issue and has been developing some alternative measures to basically get an idea of what those revisions will be. And if I use those adjusted numbers, I get this black line again. And I think that the story that comes out is, on that measure, at least through the middle of 2012, Salem is not actually as far below norms as you might expect it to be given the unadjusted data. I'm not saying that job growth here was exciting over the last 2 years, but it certainly was not as dismal as some of those preliminary numbers would lead you to believe. And certainly, I think that's an important story to tell as we look into next year, is that if in fact we're really this area is really tracking closer to where it should be relative to past history than we thought, then I think that bodes well for where the forecast would go over this year. And that is something that we're going to have to see evolve, certainly over the next few months. But I do expect that data to be revised up a little bit more optimistically. And again, that gives me a little bit more optimism that as the state economy continues to improve over this year, we're going to see those benefits really leak down a little bit more broadly to local areas. Now, unfortunately, some of that gain will not happen. Did I miss one? I'm going to go this one first. Some of that gain will not accrue to revenues very quickly. As we all know, property taxes are a central source of municipal revenues in the state, and we're still well below the average rates that we were at in far as building permit activity going into this recession, and that's still a huge, loss of relative taxable value that we would have had otherwise. So even as we start to see the economy improve, it still could be a year or 2 years before we see that really build up into construction activity and start to build up into, again, more permitting activity and more taxable value. So that's, it's kind of the good news with the bad. The good news is we're heading in the right direction a little bit more aggressively than I've been able to say for the last couple of years. The bad news is, of course, we know we're still in a hole, and we know that the sources of revenue that get us out of that hole are probably going to be lagging some of that recovery a little bit. We have to have the job growth up to get the household formation up, to get the construction activity up. There's this chain of events, and even though the chain is in motion, we're still waiting for some of that to catch up into revenues. And so, when we look at projected and actual revenues for the area, and again, this is, I do these a lot, and I don't want to make anybody feel bad, but because we see this across the state, these are not unusual pictures where, relative to our pre-recession trends, we're still, racking up a shortfall relative to where maybe our long-run budgets have been previously. What I am hoping is that we move through the rest of this year and into 2013, if we avoid all the pitfalls, then that will give us a little bit more hope that the revenues going into the next budget period and the 2014 budget period might start to look a little bit better than our expectations, which I think is a reasonable upside risk at this point, given how we don't have very good expectations at all. So there's something good about keeping your expectations low. Disappointment doesn't happen easily. So that's the summary in 30 minutes of of what we're looking at, and I think what many municipalities are looking at as they move into this next budget year and the one after that.
Well, thank you very much. Are there any questions? Councilor Clausen.
Thank you. Thank you, Mr. Dewey. That was a great presentation. Very well said, as usual, and easy to understand. I had one question about the chart you put up there that shows our economic activity in Salem, and 0% is average and, up and down is negative. What is the level on the negative side that starts to look like recession? Because some of those numbers are pretty low there, and, I know with the way that scales out.
That's an interesting question, and I don't know that we have a good sense on the local level of what constitutes a recession or not. Obviously, if we drop from 1 to -2, that's a pretty steep fall, and that's the kind of falls you see with a recession, and we still haven't seen a lot of bounce back from that. So, and the job growth here has been, it's been relatively flat. It certainly is not worse than anticipated, but that, generally in an expansion, you'd see rapidly rising job growth. So, I don't want to say that we've been in a recession for 2 or 3 years, but, if I said that, probably a lot of people would say, yeah, we have been. And that's, again, there's these very low rates of growth in historical terms. Below one standard deviation of norm would generally be something significant of note. And part of that's it's not just the government sector, laying off people or not growing as quickly. It's also the private sector has not been quick to catch up. So it's really only in the last year that you've seen that job growth stabilize, and that's only using, again, what we think are going to be the revised numbers. And zero job growth would be well below norms, right, in this region, and that's what we're seeing. So you try not to look at the blue line so much because that's a little bit spiky. It's volatile. This is an interesting issue. As you go from national data to state data to local data, it becomes messier.
Yeah.
One firm, or one company builds 100, complex apartment building, and then suddenly the data is just, off the norm. And so I look at that 6-month moving average to give me a better sense of what's going on. I'm hoping that that's going to pick up again, given what I'm seeing in other parts of the economy. But certainly this region, like Southern Oregon, like Central Oregon, has lagged in a broad range of indicators in this recovery, and really the only standout is the Portland region. Portland's growing not terribly less than pre-recession rates, and it's really everybody else that's not growing substantially, and so that's why Oregon's job growth is probably, again, that's another number that's going to be adjusted. But once it's adjusted, it's probably going to be around 2,000, a little bit more jobs a month. And during the heights of a lot of these recoveries, you're looking more at, that's going to be 25,000, 26,000 jobs. We're looking at, 35,000 to 45,000 jobs would be, I think, what much more consistent with what people would expect. And part of that's because it's just one region. Once you add it in, if you could get some job growth in Bend or Southern Oregon here, a little bit more in Eugene, then, that would really help the state numbers.
Thank you.
Is that a long answer? I hope it's not too long.
I like it.
Sharon, did you?
Thank you. One of your last slides, you have a prediction of higher payroll numbers.
These are non-farm payrolls, so jobs,
Correct,
employees.
correct. Yes. Your 2015, I believe, prediction is actually higher than it was in 2007. Could you just clarify how we suddenly get to that?
So that's very similar to, if I shrink the statewide numbers, that would be very similar to that. And the story is that if the regional economy, or if the state economy starts to improve and the region continues to follow the state as it has done historically, actually this is the one we want, then we'll see job growth start to accelerate, and that's the hope as we move into the next a couple years. In one sense, you're looking at 6,000 jobs over 3 or 4 years. That's actually not that's not an insurmountable number in that span of time, especially if you think of going into the next biennium. The state's not going to need to do as much cutting or could possibly even start hiring again, and that would take one drag off of these regional job numbers pretty quickly. And that, alone would start to help add those jobs back into the economy. So it is dependent upon the future being like the past, of course. But so far, again, I don't think the region's been terribly off as far as job numbers where we might think. But certainly, everything's been growing slow, and slow in the state means really slow here.
Thank you.
Could you go to the state revenue slide again? And
that's this one. And this is from the Office of Economic Analysis from the August
August forecast.
August one. We don't have the December one yet because it's November. But I'm not sure that there'll be a huge amount of near-term changes in those two forecasts at this point. And you could see this flat period here. We've had 2 flat periods over this past decade, and if you'd extended this trend line out as many legislators in the late 1990s had expected, we would be obviously in a much different fiscal position than we are now.
Okay.
Was there a question? I'm sorry, or did I?
No,
answer it?
I just wanted to see it again.
It does tend to accelerate a little bit as again, as the economy improves. That would be the expectation. So.
Okay. Thank you.
Yes, I don't know if you've looked at this, but one of the things that we're facing increasingly every year is additional loss of property tax revenue to compression. And I know a number of cities around the state are. With the slow level of growth we're having and kind of rapid additional loss to compression, have you done any modeling about how long it takes to go through that process, how much growth you would have to anticipate before you can pull out of that?
No, I haven't. Nobody's asked me the question yet, but that's an interesting question because obviously the caps on revenue gains are very much binding, and unless we really do have a substantial amount of property, new construction, that's going to be a continuing problem going forward, unfortunately. I don't have any better answer for that.
And,
That's an interesting question, though. Nobody's asked me that.
Our compression is the amount of loss in dollar terms has been pretty much doubling every year for the last 4 years, and in our projections is continuing to increase at that curve. So even though we have, it's good news that there's some additional permits and some additional construction starts. I think
and that's why
counterbalance is not
and
there.
that's why, again, if it's going to take a couple cycles here for it to build sufficiently to start to give enough of a boost to help some of these fiscal issues, unfortunately.
Okay.
But we can also talk about that
It would
separately.
be interesting to see that, so we can talk later.
Right.
Yeah.
Okay.
Any other questions? Comments?
Just quick,
Councilor
will be able to get copies of the presentation?
Are those available?
Yeah.
for-
Well, we've
yes,
done that
yes,
before, if I
we
recall.
have an
They're on your computer,
electronic
so-
copy, so we can send that out to the counselors and the budget committee members.
Thanks.
No problem.
And put it on our website, I think, for other people who might want to see it again.
Anything?
I guess the only other thing would be if you have any words of advice as we think about our financial forecast.
We're just
for
doing the
next
same
5
thing
years.
we've been struggling along with for the last 2, 3, 4 years now, is that we're still trying to, and most areas, again, are trying to find creative ways to make ends meet, and they're running out of those creative ways, unfortunately. And eventually it'll have to come down to the issue of when taxpayers want to be more supportive in other dimensions, I think, for a lot of these local areas. And the way the property tax system works obviously constrains some of our budget decisions going forward. And that's, there's just no easy story that I can tell to get us out of that. That's in so many ways a problem that Salem probably has to think about a little bit more aggressively. And it probably will have to, because some localities are almost going to shut down if they don't start finding some real revenue fixes. But that's the words of wisdom are, no one's immune to this. With, again, Portland doing a little bit better than the rest of the state. But this is a story for city councils across the state.
Okay. Thank you very much.
Excellent.
Thank you. And that's the end of our meeting. We were going to do the fourth quarter financial reports. There are a couple things I wanted to clarify on that and didn't want to get it out to you with 1 day notice. So we'll do that on the 28th, on November 28th.
Great.
Excellent.
We're done. Thank you very much.